I haven't seen 60 Minutes in a while. I don't watch much of any television, man.
Remember where it started,
tell me.
Marcos, who you missed?
What?
Bushy eyebrow guy, Andy Rooney.
Wait, what am I missing?
That's where it all started. Watching Andy Rooney with his bushy eyebrows complain about what he saw in the world. And that was starting my love affair of 60 Minutes.
Wow. 60 Minutes. That's how we should chime in or out. Tick, 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 tick.
Well, our old
That'd be
viewers
awesome.
would totally get it. Our young viewers would have no idea what we're talking about.
I wonder if we can do 20 minutes instead. And they'd be like, yeah, I know. Guys, make this shorter, please. What was I going to say? Oh, so I'm sorry, because I thought about watching stuff. So you know what I'm going to do now, and I'm going to get the movies.
Brett, have you seen?
Well, I'm going to assume that you've seen Fight Club.
Oh, there you go. Yeah.
Yeah. That's what I got to do. I got to go back to that late 90s, early 2000s to get you to do things. So
there's only one rule in Fight Club. What starts in Fight Club ends in Fight Club.
Oh my God. You don't know it? You don't know the one rule?
What happens in Fight Club stays in Fight Club. No,
that's Vegas, man.
Vegas. I don't know.
That's Vegas. You don't talk about Fight Club, Brett.
Oh, of course.
God.
Some of us have other more important things in our
Now
brain.
I have to text Brad and Ed. And, oh my God.
Welcome to a Halloween episode of Talk Your Chart. Marco Segura here with Brett Horowitz. We are episode 45 coming to you on October 31st. And I want to talk about bonds to start off, because what just happened the last week, interest rates hit over 5% for a 10-year treasury. And so we have lots of clients who are coming to us to say, man, these rates are so phenomenal. I really want to take advantage of what's happening. We haven't seen these rates in 15 years. And so we're going to start here with a chart of different maturities, the first colorful chart here, okay? I guess the way to look at it would be you've got everything from 1 month treasuries to 1 year to 5 year to 10 year up to 30 year. And the one that's paying the most is going to be your 1 month treasury. That's your purple, okay? The ones that are paying the least are going to be your 5 year, your 30 year, and your 10 year. So a lot of clients, and we can see the giant jump that's happened in the last few years, but a lot of clients look at this and say, well, my gosh, why would I own anything beyond a 1 month treasury, right? Why would I want to own a 30 year when I make less than owning a 1 year treasury? So I would first state, and I want to hear your explanation afterwards, but I would say the bond market is predicting that if you were to own a 1 month treasury and keep holding that and letting it lapse and then buying another one for an entire 30-year period, you'll have the same return as the 30-year treasury, because we expect that rates will be going down next year, the year after, whenever it is, and such that I'd almost rather, I think, be locked into a 30-year treasury for that slightly lower rate, because I think that rates are going to be lower going forward. What are your thoughts? Why are you looking like you're bored?
Because you explained that perfectly. This is literally just math. That's how these things are supposed to be priced. That if you renewed it every single year for 30 years, you're going to get the 5.03%. That's what's supposed to happen with math. But then the Federal Reserve increases rates by 1 billion% over 12 months, and weird things happen. That's it.
Right. So that's why these rates are changing.
Let me ask you this, Brett. Why in the world am I getting paid more to own 1 year debt over 30 year yet? That's an inverted yield curve. That's not supposed to be a thing. Where's the recession? I don't know.
No, but we know that clients tend to default to looking at the shorter term nature of things. They tend to look at, what am I going to do for the next month or 6 months or 1 year? So we lock that in, and I'm worried about 30 years. But in reality, 30 years making 5%, it's a pretty good return.
Absolutely. And again, we're talking about this stuff so much, but I guess it's because everyone's talking about it and that's our job. Getting paid 5% is nice, and earning some actual money on your cash is real nice. This is the worst recorded bond bear market in history, basically. So we've got to witness history. What do you have on? You have a 30-year, right? So owning long-term bonds has been such a god-awful trade in the last 5 years. I want to say 5 years, right? It's probably been 5 years of just terribleness right now.
So the second chart I want to share is that while clients, yes, they're focused on short term, we think they should be focused more on long term, looking at locking in rates for a longer period of time than just for the next 1 month or 1 year. The other thing is that I'm not so excited about a 5% treasury bond, because what we know about treasuries, there's virtually no risk, right? The government has always paid back their money. And so as a result, the yield you should get on those bonds should be the lowest yield that's out there compared to other bonds. And what I want to contrast it to here is the U.S. corporate BBB yield. BBB, if you know anything about ratings, you have AAA, then AA, then single A, then BBB. All those are considered investment grade, high quality bonds. You can get an extra 1% over even the 1 month treasury by owning the BBBs. And I know some clients are going to look at this and say, well, what is the risk of owning a BBB? Here's a stat for you that I may have used in the past. I don't recall.
Love stats.
The average annual default rate amongst BBB issuers from 1920 to 2018 was 0.26%. That's how many defaults there are over that period of time on average. Since 2009, it's 0.08%, and there's not been a single BBB default since 2014. So is there more risk by owning BBBs? Slightly, but can you really call it much of a risk when the default rate is that low?
Wow. That corporate investment grade of 6.5, what maturity is that? Is that 7-year? So what should we compare it to?
Yeah, that's probably a 5 to 10 if I had to guess, somewhere in that range.
So somewhere in between the four. So call it 5, 4, right? So you're getting a 2-point spread to take what is pretty not riskless trade, because obviously there's a spread for a reason, but a pretty measured amount of risk.
But I think one needs to take that into account that you don't want to just buy one BBB corporate bond and be like, okay, I own, McDonald's, for example, and now I got my BBB and I'm good there, because you want to spread it out. So probably a fund makes more sense than owning one single issuer.
Yeah, exactly. I think this is good to see. I don't think a lot of times folks get to look at a treasury curve and then see what the corporates are paying. Because everyone's kind of, why wouldn't I just own treasuries? Why wouldn't I just own treasuries?
Exactly.
I mean, sure, but why not own investment grade corporate bonds?
Yeah. Now, with all this being said, the other things that clients talk about is bonds have just been abysmal in the last year.
Oh, there it is.
So what we're showing here is charts of 3 different sort of maturity level bonds. One's a short-term bond fund, one intermediate term, one long-term. Long-term down 50% over
These
the
are all
last year.
treasuries.
All treasuries. Right. So even though treasuries are safe from if you hold to maturity, while you're holding them, they could be down a lot. And so a lot of clients look at this and say, get me out of bonds, get me out of bond funds, because this is my experience. We're probably closer to the purple, right? Our bonds were only down about 6-7% because we were not so long in maturities. But they're saying, I've given up on them. I want to get a 5 guaranteed because I just lost money in my bonds and I don't want to, experience that ever again. Right? You must hear that all the time.
You hear it, and then you try to give them, like, you participated in the bad part. And by the way, the bad part was literally the worst bond market since the 1800s. At this point, it's just basically in all of recorded time. Why don't you stick around? Because the good part's coming.
Right. So let me read a stat that was surprising to me. Is that the 20-year bond ETF, Treasury bond ETF, is, as we see here, is about half its value from 2020. But investors are piling in. They said there'd been more money added to that than any other fixed income exchange traded fund in 2023, and almost all equity funds. So what people are saying is they are betting yields are going to fall. And the math suggests that the longer maturity you own, the more gain you're going to have. So for example, if you bought a 30-year treasury and rates went up 0.5 percentage point, you would make 13% return. If rates went up 1%, you get a 23% return.
There you go.
So, and the chart I'm showing here, the other chart is now showing what the returns were when rates were going down. And you can see how it's completely flopped. That longer term treasury bond was up 107%, where the shorter term treasury was only up 6%.
There's a case to be made that TLT is looking pretty good, my man. It's asymmetric. It was asymmetric before when rates were 0%, right? Like it made no sense to buy it because there was just a bunch of downside.
Right.
But now with rates at 5%, I don't know.
Yeah.
And so you can do the math faster than I can, but if rates go up by 1%, the amount of loss is nowhere near as large as the amount of gain from rates dropping 1% from this point.
Well, there's still risk. You don't want to, I don't think you
Well,
want
hey,
to.
whoa, who's saying there's not risk? Did I say no
No.
risk? When did I say that?
I don't want anyone to get confused by saying, like, we've already said rates are at the top and they're going to go down, right? They could keep going up. So I don't want anyone to jump into 30-year treasuries. But I think the point is that this could be a great trade going forward. That instead of focusing on, again, that 1 month, that short period of time, look at how much you can get if you're in a bond fund and rates start to go down, or you're in bonds and rates start to go down.
I know. This begins the conversation of from Tina to no more Tina. Now there is an alternative to equities.
Okay. Moving on. I've said my piece.
What, did we skip one of your charts or no? We got them all.
We got them all.
Beautiful. God. TLT absolutely smashed. Oh my gosh.
What you got?
I think I want to talk about consumption. So, and you have one other chart here. I guess we'll kind of, you'll bring your chart in. I think it'll pair well with the story here. So I read a blog by a gentleman named Ryan Dietrich, and he pulls some data from the Survey of Consumer Finances. The Survey of Consumer Finances, it's put together by the Board of Governors of the Fed. It's a cross-sectional survey of U.S. families. Survey data includes information on families' balance sheets, pensions, income, and demographic characteristics. It's basically a blood test of, hey, how's everyone doing relative to your consumer finances? What was the last GDP, Brett? I know you love when I ask you questions.
Why don't you tell us what it is, Marcos?
No, you're going to tell us. Was it above 4%?
I think you should tell us.
It was 5%, dude. We had a 5% print in GDP, which is, where's the recession? Who was calling for a recession to start this year? There's still time, is all I'm saying. Anyway, so a big print in GDP, which is the battle that the Fed is fighting, right? If you're trying to slow things down to curb inflation, make sure that doesn't run rampant again, or you get this resurgence in it, you don't necessarily love growth continuing at this pace. So that puts pressure on them to keep rates higher for longer, even increase rates more. Given all that's going on, I think the narrative around another actual rate increase is probably not there, but the market's kind of doing the job for them because the market is naturally raising rates, right? Kind of saying, hey, US government, your balance sheet's looking a little dicey. We're going to require you pay us a higher rate of interest in order for us to assume your debt, right? To be a buyer of your debt. Okay, got it. Why is GDP so great? Well, remember, our GDP is driven 70% by what? By consumption. So why are consumers, you, me, everyone in this office, and the folks outside the window here, why is everyone still fine if all this bad stuff is happening? I think the first thing to point out, and you pointed this out last episode, you probably pointed out almost once an episode, where's unemployment right now? It's still real damn low. So people still have jobs. When people have jobs, they feel confident. People feel even more confident when they have a job and they think if they lose that job, they could get another one real quick. And there's still over 10 million open jobs to go capture. 9 to 10 million. Okay, fine. That's still there. What else happened that I think this kind of set of charts shows us is the record rise in real net worth between 2019 to 2020, which of course is going to include housing. I didn't really talk about housing because everyone knows what's happened there, but housing's part of this, but it's not just that. And the comparison to the previous 10 years is like an astounding figure. So when you look at this, and the first chart I have here is just pretty on net worth. I'm going to read a bit from this. So after adjusting for inflation, median net worth jumped by 37% between 2019 and 2020. Median real net worth, so that's after inflation, right? Rose from 141,000 in 2019 to 193,000 in 2022. This is the largest 3-year increase since the survey began in 1989 and stands in sharp contrast to the 2007 to 2019 period when net worth fell 18%. Obviously, that means great financial crisis is in there because it starts at 2007, but that's going from 2007 to 2019. We had a real drop of 18%. Talk about feeling terrible about yourself and having no desire to go want to buy stuff. In this previous 3-year period, which of course has stimulus involved, you got this massive jump in real terms. Again, everyone's afraid about inflation. This is a real figure, meaning inflation's adjusted, of 37%. How does that make you feel?
Well, it makes me, to me, I think that people like to complain. And I think depending on what side of the political aisle you're on, you either see it as great or horrible. Because I'll follow that up with another statistic that just came out recently that I was shocked at. And the statistic is that the Federal Reserve just revealed that the average net worth of Americans topped $1 million for the first time, surging 42% from 2019. So that's sort of similar to what your chart is saying.
Yeah, exactly.
And now 16 million families, about 12% of the US, have net worth exceeding $1 million. And there are about 8 million families who are multimillionaires, up 2 million from 4.7 million before.
Yeah. To your point, look, crappy news is going to get more attention than good news. Hopefully this can make a little bit of news. So
it should. People are feeling better about themselves. That's why they're spending, right? And we wouldn't be in this great economy if everyone's feeling horrible about themselves.
The other side of this thing is obviously credit card debt's going up. Okay, that's fine. We get it. But we still have a consumer that's more resilient and ready for a downturn than the one before the last downturn. Another quick chart here with a green line, a yellow line, and a blue line. This is showing total debt relative to assets, ratio of debt payments to family income, and percent of families with debt to income greater than 40%. And as you can look, this is not a chart from the last 6 months. This is from 1989 to now. The lower, the better. So this looks good.
We need to be clear. I don't think two of us only look at the economy as rosy and like are only showing the rosy charts, right? Like, I mean, there's certainly some bad news out there.
Yeah, let's see CNBC report that.
If you were to balance it on a scale, right, you got a lot of good news over here and you have some bad news over here, but a lot less.
Brett, if we were talking about all the bad stuff, what the hell would CNBC talk about? We can't steal all their viewers at once. That would be so unfair. We're not allowed.
We need to be fair and balanced.
Another point, mortgage. I heard you having a little mortgage conversation in the water cooler in the office recently. So last chart, this is just talking about mortgage. Obviously, mortgage rates are crazy. I'm never moving from my house, 2.7% mortgage. Oh my gosh, beautiful. Why hasn't it hit us? Look at this chart. So this chart on the left side of it, it shows shares outstanding mortgages with variable rates across countries. Hello, Australia. At about 80% of their mortgages are variable rate. Hello, US. Sub 5% of the mortgages that we have outstanding are variable rates. There you go. And then on the right side, you're just getting mortgage debt as a share of disposable income. Good job, Italy, having the lowest share on this chart.
So I did a quick interview with a reporter this morning, and she was asking about people that are cash poor and house rich. We have a number of clients, you and I, as well as the firm, people that have either a low debt or debt that's been refinanced at low rates or no debt, where even though their house payments are not a lot, they can't afford to stay in their house forever because of their portfolios dwindling. So, you know, it helps that rates are low, but you also need to have other assets outside because you're not able to spend the equity in your house, which has gone up dramatically over the last few years.
Asset classes, liquidity profiles, pre-tax, post-tax, tax-free, just have a little bit of everything.
Well, it also means though that if someone's going to sell and rent or sell and downsize and their expenses go up, that's not a bad thing if you now have all the equity that you can now use or half the equity that you can now use.
Well, yeah, there's that whole idea of you have a sheet of paper that shows all its equity. And you're like, ha, look at me. This is awesome.
Right.
Well, what are you going to do with it?
Right.
It's just sitting there. In very odd fashion, I'm going to end on an optimistic note.
It's not like you.
I know, it's incredible. So here's a fun chart that's got pretty colors, shades of yellows, oranges, reds, and greens. And it's showing us the average 10-day returns across different months, 1950 to now. So it's basically telling us just a calendar year basis what the returns are each day in a month, 1950 to now. Green, good, red, bad. And you know what I noticed on this chart, Brett?
Body green and yellow.
Well, yeah, of course. What I'm noticing, Brett, is that we're walking out of an area that's just been historically terrible, August to September, and walking into the beauty that is the end of October, which I guess we're still kind of waiting for, even though yesterday was a big day. And walking into the end of the year, which we got a little Santa Claus rally.
Well, we'll see. I don't know. October was, I mean, these dates, the last 10 days of October should have been good. They were not that
No,
good.
I know, and they were not. They were terrible. These are fun. These are fun charts to look at because they're random, but at the end of the day, they're telling you something. So whatever you want to do with this mosaic, Horowitz, you do with it. I'm going to go ahead and say Santa Claus rally. Here we come.
Or treats coming to us all.
Are you going trick or treating?
I'll be handing out candy for 2 hours. We bought $150 worth of candy to give out to kids. It's outrageous.
Wow,
how much
cheapskate.
candy is.
They buy you like 4 candy bars, dude. $150?
But my neighbor gives out toothbrushes, so we've got to be, you can't be that neighbor. We got to be the one that gives out the candy.
Oof.
She's a dentist.
Wow, you just put that guy on blast. What's your address again so everyone knows what house to avoid?
They're mini candy bars. They're not the big ones.
No, I want everyone to avoid the toothbrush guy.
Oh, yeah. She's next door.
Oh, man. All right, episode 50, whatever, 45 in the books. 50's coming up. Coffee time.